A $50 million jet, 2 helicopters worth over $12 million each, a $500,000 Rolls Royce. Purchases just like these is what Grant Cardone has used to save over $35 million in taxes. Millionaires and billionaires understand this, and they've decided to take advantage of the system. Now, you might think that these types of strategies are only available for rich people, but during this video, we're gonna be going over step by step, mathematically, how you can take advantage of it no matter what stage financially you're at. For those of you that don't know who I am, my name is Sebastian. I currently own Guerra Financial Group. It's a wealth management firm that currently has about $800 million under advisement. And the reason I do these videos is to be able to share real ideas and strategies that we use with our clients that maybe you might want to take advantage as well. With that said, let's jump right in. So if you don't know who Grant Cardone is, this guy has turned into a very, very successful business owner over the last 5 to 10 years. He has a ton of companies at this point. He has a real estate fund. He has a sales training company. He has Cardone Ventures. He's created a ton of different companies, and all of these companies, they make a ton of money a year. So this is exactly the steps that he has taken to be able to eliminate the most in taxes as he possibly could. Every single one of these companies, they all generate revenue. Just picture it this way. Imagine Grant Cardone had 5, 6, 7, 8 different companies. And every single one of these companies, they all make different amounts of money every single year. So you might have one company that might be having $50 million a year in revenue with $40 million in expenses and $10 million in profit. You might have another company that might have $100 million in revenue with $80 million in expenses and $20 million in profit. Let's say another company is $40 million a year in revenue, $30 million in expenses with $10 million in profit. And let's say like company 4 has $60 million in revenue with $50 million in expenses and $10 million in profit. Now, when you pile up all these companies together, there's a ton of profit left over. One left 10 million, the other 20 million, the other 10 million, and the other 10 million. So overall, Grant Cardone has made $50 million in profit from all of his companies. So this is what he does. At the end of the year, he realizes, how can I use all of these different purchases like jets and helicopters and cars? How can I go and make very expensive purchases under these corporations so that way now that corporation creates a loss? So picture it this way. He had $50 million in profit between all of these companies. He now goes in and he decides to go and buy a $50 million jet. If he wouldn't have bought the $50 million jet, he would have had $50 million in profit. And in the United States, depending on what state you live in, $50 million in profit, you would have to pay income taxes of about 37%. And depending what state you live in, you might have to pay another 12 or 13% more. So overall, $50 million in profit, he would actually only take in his hands $25 million in his hands because he would have to send the IRS $25 million additional. Instead, what Grant Cardone decides to do is he says, okay, instead of me going and not buying a jet, what I'm gonna go do is I'm gonna go apply with a bank for a $40 million loan. And so what he's gonna do, he sees the jet that's $50 million. He's gonna take from his own pocket $10 million as a down payment. He's gonna get $40 million from a bank to lend him the money to go buy the $50 million jet because it's being purchased now through the business. That now creates a loss for that business. So let's say that one of the businesses had $10 million in profit, and now he buys a $50 million jet under that business. Now that wipes out the entire profit of that business. But he might have another 2, 3, 4 different companies that he might have had a ton of profit in those companies as well. So any losses from company A that he now lost $40 million in losses because he bought a jet, now he can use them against the other corporations that now he has. So even though he made $50 million in profit, the one purchase of the jet has eliminated the entire taxation on those $50 million. That specific code is called Section 179 using what's called bonus depreciation. So the question is, how can you take advantage of this exact same strategy that millionaires and billionaires like Grant Cardone are using so that you can actually save a ton of money in taxes? So this doesn't matter if you're making $50,000 a year, $100,000 a year, $1 million a year, or $10 million a year. It doesn't matter how much money you're making. What matters is how to implement the strategy for your specific situation. So let's say that you're making $100 grand a year. Under normal circumstance, you're probably paying anywhere between $20,000 to $30,000 a year in taxes, anywhere between 20 to 30%. So the goal, whenever you have a business that has profit at the end of the year, the goal is on paper, you want the business to have no profit. And that doesn't mean that you want the business to have no profit. You just want it to look on paper like it has no profit. So What you can go and do is, you're not going to go and buy a $50 million jet. You're probably not going to go buy a $500,000 Rolls Royce. You're not going to go buy a bunch of helicopters, but you might end up saying, hey, you know what? I am going to go buy a $30 or $40 or $50,000 car. Now picture it in this format. You make $100,000 a year. And under normal circumstance, you now would have to pay $20,000 to $30,000 in taxes, which is 20 to 30%. But instead, what you've decided is you've decided to go and buy a vehicle under that business. Now, there's certain rules around it where there have to be a certain amount of weight and the car has to be used for business purposes and things like that. There's a bunch of rules around it. But let's just say you go buy the vehicle that's above the 6,000 pounds. If you run it through the corporation, in other words, you're buying the vehicle through the corporation, that doesn't mean you have to go and take out 50,000 out of your own pocket to go buy the car cash. I think that's where the mistake happens with a lot of people. A lot of people think that they have to go and take out 50,000 from their bank account to go buy the car cash. You don't need to do that. What you can go do is you can go put $5,000 or $10,000 down. You can go get a loan of $40,000 from the bank, from the dealership, from wherever you're purchasing the vehicle. And then now what you're doing is you've essentially purchased a $50,000 item. So your original $100,000 in taxable income, all of a sudden, if you buy the vehicle through your business, now it brings the vehicle as a wipeout from your $100,000 of taxable income. So you have $100,000 in income, the vehicle's a $50,000 car. So now all of a sudden, you don't have $100,000 in taxable income anymore. You now have $50,000 in taxable income. And if you understand the different tax brackets that exist, because there's a 10%, 12%, there's a 22%, like there's different tax brackets. Once you start getting below that $50,000 income range, now you're paying only 10 or 12% in taxes. So imagine you now have $100,000 in income, you go buy the car. Again, you didn't pay cash for the car. You got a loan for $40,000. You put $10,000 down, but then now you only pay taxes on $50,000. So when you break down the math, you're probably only going to pay $3,000 or $4,000 in taxes at the end of the year on the $50,000 that you have of taxable income, rather than the original $100,000 that you had in taxable income, and you were going to have to pay $20,000 to $30,000 in that scenario. Now, here is where I think the mistake happens, is many people, they hear all these things on YouTube, on the internet, and they hear of these strategies, but the problem that happens is that most people don't know how to implement the strategy. And that is where you have to have a good accounting team, a good financial planning team, a good banker on that side when you can acquire the loan. So you want to make sure that it's not about having an idea. It's how do I go and grab the idea and actually be able to implement it? Because if I right now am a business owner and I do landscape or I sell trucks on the side, you don't know how to implement the tax strategy. And so you want to make sure that you're speaking to a tax strategist, you're speaking to a financial planning team so that they can actually grab the information, this idea, and implement it for you. And I think that's where the biggest value that you're going to be able to get out of this. So if you're in that exact situation where you're probably making good money and you're realizing that you're going to go have to write a giant check to the IRS on a yearly basis, what you want to make sure is that you have a tax strategy team behind you to make sure that they're implementing all these strategies for your specific situation. So if you're in that specific situation where you're now starting to make good money, but you're realizing that you have to pay a lot of money to Uncle Sam, you have to now start coming up with these strategies. So we actually offer what's called a free 90-minute wealth strategy session where you'll actually meet with a wealth strategist and they're going to review everything that's going on in your entire financial picture, not only your taxes, but also your investment strategy and what you're doing to build wealth long term. So if you go to the description section and you click on the little link below, there's a Calendly link and you can book a free 90-minute session with one of our wealth strategists. So if you're really enjoying this type of content on the subject of finance and taxes, you can actually check out one of these videos and don't forget to like and subscribe.